This ticker podcast is coming to you from the Citadel Securities trading post on the floor of the New York Stock Exchange.
Hi, everybody. In an era when algorithms do most of the buying and selling of stock, this place is one of the few places left where human interaction and judgment still play a role in the exchange process. Today, we'll follow that theme. It's hard to ignore the barrage of high-tech tools aimed at IROs these days. But while technology has certainly forever changed how the investor relations sausage gets made, the fact remains. Human interaction still is, and most likely will remain, the bread and butter of the investor relations job. On today's program, planning your most successful investor day ever.
The biggest thing is to really plan ahead. Talk to your management team, get the buy-in, make sure everyone's on the same page.
I'll get face-to-face with an investor day expert. And accelerating your IR strategy. The auto and truck supply chain, talking about the companies that make component parts or sell or rent or repair or anything else in the supply chain, that sector is shifting into what many see as a period of perfect storm conditions. And all of it is kicking up a pile of doubt in the marketplace. My first guest says it's time to push the pedal on proactive IR.
Most of these worries were overblown, in some cases in conflict with how those same factors were being reflected in the overall market.
Counter-messaging that cuts through the noise of the pack. That's up first on your Ticker podcast. And I promise, no more puns. I ought to know better than that. I don't want to drive you crazy. Seriously, besides, I'm getting tired of them. Bobby Winters knows what drives Wall Street. A former analyst and portfolio manager, he's seen it from both sides. He knows small caps, he knows emerging markets, fixed income, metals, mining, materials science, energy. And the poly-talented history grad also knows America's automotive business. Winters now works out of consulting firm Alpha IR Group's New York office. And he's penned a white paper on how IROs can actually take advantage of current uncertainty around the auto and truck sector. He dropped by the Citadel Securities post to explain how.
Bobby, you talked to plenty of people on the street and you've detected a lot of investor angst over apparent headwinds facing car and truck suppliers. But you think a lot of those fears are overblown. Maybe we can start with the perception of and impact of potential trade wars.
Sure. So that of the many issues we covered in the report we put together and put out, I would say that is the one that's actually the most real in terms of or the highest on the list of a worry level that could actually have an impact. Having said that, there are offsetting factors to some of those. And part of this is the moving target. So first we look at the level of potential tariffs. And whether or not they'll actually be fully implemented over time, we want to look at them in the context of the size of the market, the industry, and the economy, and the potential impact there. And in that case, when we looked at the potential impact of those, relative to the size of trade between the U.S. and China, relative trade in the U.S. and Europe, other major economies of the world, and other potential offsetting factors, if that's merely viewed as a cost, what are other factors that are happening that could offset that? Not just specific to the sector, but specific to the economy. Because at the end of the day, demand for autos is affected by a lot of things, that take place in the economy. Here, we wanted to remind IROs to remind their own, either existing investors or potential investors, to look at things like the size of the tax cuts having an impact on both personal tax cuts and corporate, and the still, in our opinion, yet to be fully, the effect of that is yet to fully be manifested through the economy. So there's a tailwind effect to that, which is having some effect on the economy yet, but is not yet likely played its way through the U.S. economy.
So the threat of trade wars is offset by the strength of the economy.
Potentially, or potentially even more than offset.
And
so
the tax
again,
cuts.
looking at the size of those potential costs, and again, they impact certain industries more than others. So there's no doubt there's a reason why, in investors' minds, industries like the automotive companies and the auto suppliers are at the top of that list, because the relative content. If you look at healthcare, or you look at the pharmaceutical industry, you'd be hard-pressed to find any impact, because steel and aluminum are not generally involved there as a cost item. Okay. Obviously, in the auto case, the auto parts, the auto companies, they are. The content of steel and automobiles, the growing content of aluminum, those are factors. So our point is not really to be dismissive of the concern or the question. It's actually more to gauge it relative to the broader events, tailwinds or headwinds that may be going on in the economy that affect overall levels of demand for cars in the U.S. and in other parts of the world, and also the ability to pass on some of those costs over time.
So what's the message to IROs then? Faced with that argument, what's the counter argument?
Well, on that specific issue, which is it is one factor in looking at and analyzing these companies and looking at what's going on with them currently, but going forward. Because again, there is a lot of rhetoric right now around these around trade, and we don't really know how this is going to play out. Looking out 6 months from now, 12 months, or even several years. So there's a question of, is it as a temporary cost that it will either go away relatively quickly, or the ability to be passed on, or is there a major structural change underway that will cause large supply chain adaptation changes in the future as a result of these trade actions? That would obviously be something much larger that needs to be factored in. We don't think we're there yet. We don't think it's likely that we're going to be headed there. But again, on this specific issue, our point is really that the potential costs of this need to be balanced against other, what we see as tailwinds, positive factors that are present currently and may be present going forward for this sector.
Maybe. Okay, one thing we do have a bit of forward vision on is the fact of electric vehicles.
Sure.
Likely inevitable. When? Maybe not so much.
Right. So here, I think everyone is in agreement. I think everyone in the automotive business, the automotive supply business, is not only in agreement that electric vehicle demand is going to be substantial going forward, but that is a big part of the future. They're also most all of them are positioning themselves for that. So that's another. So the idea is electric vehicles is not, for many of these companies, actually the suppliers in particular, is not so much a risk as it's just as much as an opportunity. Okay, and many of them are investing as heavily in that side of their business as they are in the traditional historic internal combustion engine side of their business, and in between, to hybrid vehicles and engine, and then other things on that spectrum. So our point there is that electric vehicles, one, we're starting from still such a low base that even at very high growth rates, looking out 5 to 10 years, you're still a vast majority of the cars in the US and in the world are still going to be built with an internal combustion engine or an internal combustion engine plus something in that. And so, and for the growth of the electric vehicle side and the technology implementation there, that is the automotive suppliers and the OEMs, frankly, are going to be players in that as well.
Okay. Interest rates. Major investor jitters. Combine that with deadbeat car buyers. What is an IRO to do about that?
Well, that's one of the ones we kind of, I would say, we find that interesting from several respects in how that is transposed as a worry on this sector right now, more so than, let's say, the overall market. Okay? Interest rates have been being raised by the Fed, but we're still dealing with historic low interest rates. When you look at automotive demand historically, it is really things that are in terms of employment levels, consumer sentiment, income levels. Those historically tend to be the factors that are more associated as an indicator with automotive demand levels, not specifically interest rates.
Recession worries. Investors will act like economists. Boy, we've been expecting a recession for the last X amount of years now. Presumably those worries are growing. You kind of touched on it at a moment, but what's the counter argument to that argument that a recession is just around the corner?
Here again, our message, our advice, is not necessarily to engage in an economic forecasting game against the market or against investors and analysts, but it again is to point to factors and things. So when you look at leading economic indicators, other things that are associated with recessions, or tend to start to break down ahead of. We don't really see those by and large right now, flashing yellow or even flashing red, let alone yellow. Part of the challenge, the problem is that this economic cycle has been going on a long time. And the stock market from the awful lows of 08-09 has been going up for a long time. Unevenly, but nonetheless, it's obviously been going on. So it's partly that the duration of that almost feels to people like that we're due.
Yeah.
And our point on that is not necessarily to eliminate that there is something that an IRO or a company can do to eliminate that worry. Our point is that you can point to indicators, okay, that are at least perceived to be, reliable gauges of the current state of the economy. And most of those do not indicate that a recession is imminent. It doesn't mean that one couldn't happen. There's always a chance for different surprises and things like that to happen. So it's merely, again, those things like consumer sentiment, like employment levels, like income growth. And then, even things within the credit area of the automotive sector specifically, because that has been an area where people have elevated some concerns. It's not completely benign, but it's also not something, when you look at it historically, that is flashing a run for the hills, run away. And I would add one additional, which is that within this set of worries we just discussed, what we do think is being lost is that these companies are managed differently than they are in the past. They are allocating capital to us in better, more proactive ways to try and create shareholder value. And that is something that we think is right now kind of being pushed, aside, as being overwhelmed by these concerns.
Fair enough. To wrap up, you point out that there's one thing that an IRO should not do, and that's just stand back, assume everything's going to be okay.
Well, the advice to be proactive is to really to try and help fill the void here, if that's the right term, that is created somewhat by these worries. Okay? And our belief is that alongside these worries, there's also the fundamental changes that are happening on Wall Street, both from the sell side and the buy side, structural changes that are underway. And that we believe that this is not just for this industry, but in this specific example, we think it's an opportunity for the IRO professionals to help fill what we view as a little bit of an information gap. It is a bit of a pushback on that narrative, but we view it from the standpoint of really to sort of proactively engage on these specific issues, on these specific worries, because we can identify them. We know what these worries are. We don't have to go and guess and find them, but each of them can be addressed, individually and then collectively. And we think that opportunity then has a chance to bring, potentially, either keep existing investors in the stocks, but more importantly, to bring other investors either to or back to the sector. That's the investment game and outperformance, really, particularly when it comes to active money management, which is who you're engaging with here. The reality is that true outperformance comes from periods of uncertainty. So we think that this is an opportunity for the IROs to help provide information to strengthen the conviction of investors to step back into the group.
And those who do that will be the ones that successfully separate their companies from the crowd.
Presumably, if what we see as underlying strength to the sectors, and that the perceived clouds on the horizon are not recessionary storm clouds or something more significant, that they are mostly either in passing or actually not as significant to the group as the market seems to be perceiving them to be right now, then that's the potential.
Bobby Winters, Senior Managing Director and General Manager of Alpha IR Group in New York City. Thanks for stopping by today.
Thank you for having me.
When it comes to really effective investor relations, nothing beats the old one-on-one with senior management. But those opportunities are limited. After all, management has a company to run. So when it comes to efficient use of FaceTime, that leaves sponsored conferences and a company's own analyst investor day. And of those two, research shows investor days have 6 times the price impact of mere conference presentations. In fact, investor days can be one of an IR program's highest return investments. Can be. They can also be dreary, useless, time-sucking duds. So how do you ensure the former? Well, a pretty good starting point might be to ask investors what they want, which is precisely what my next guest has done. Thang To is Vice President and Director of IR at Corbin Advisors. Corbin polled more than 250 global financial professionals on the topic of investor days. And Thang joins us at the Citadel Post to tell us what they said.
Thang, there's lots of how-to guides out there on planning investor days, but you took it a step further than usual. You went out and got it from the horse's mouth. Let me ask you, did anything in your research findings really kind of jump out at you, surprise you, stand out as something you weren't expecting?
Sure. One surprise in this age of everything being digital is that investors really want to have a printout and a handout of the investor presentation during Investor Day so that they can take their notes. And old school people like me really leverage that handout and refer to it in the future when we think about, okay, what exactly did they say about their strategy, and we have our notes on that page, which helps a lot in the future.
In this paperless world, paper is still has a place.
Exactly.
What can really ruin an investor day? What'll mess things up and put an IRO's career in risk?
Sure. I think the biggest thing is failing to properly prepare for the investor day. We recommend starting about 6 months in advance, and that includes, finding the right venue, making sure you have to invite the right people in terms of prospects, current investors, sell side, and that's both covering and non-covering. You want to make sure the credit, rating agencies are invited, your bankers.
The question of inviting journalists to investor days. Should you invite journalists or not?
Yeah, well, honestly, it depends on your capacity, right? If you have space, I think that's perfectly fine to invite journalists. But if you only have 50 people and there's 60 investors that want to attend, I say you have to favor the investors over the journalists. The objectives of an investor day should be to, one, broadly educate the investment community on your company, investment thesis, and long-term strategy. Number two, include updates on progress toward operational and financial goals. Number three, address any potential misperceptions that may be out there in the marketplace. Number four, showcase management, and that includes leadership beyond the C-suite. And number five is to provide a compelling view of your company as a differentiated investment. You want to make sure they understand your long-term strategy and to have all their questions answered. You asked the question before about typical mistakes in an investor day, and one is that companies don't have enough time set aside to answer questions. They may cut the Q&A short, and that leaves investors frustrated because they made a huge effort to attend your event and they didn't get the questions their questions answered. And the biggest mistake a company can make is to have investors leave with more questions than answers.
One thing your survey uncovered was that in terms of Q&As, investors preferred after kind of each breakout session.
Yeah, when we talk to investors, they typically like multiple Q&A sessions. So what we recommend is a Q&A, one in the morning and one to end the day.
Location. Let's talk about that.
Sure.
They like NYSE.
Yes, they do. So the vast majority of investors tell us that New York City, and specifically Midtown New York, is the top choice, along with company headquarters or facilities if there's something to highlight. For example, a special technology or a strong manufacturing process or a customer learning center. If there's something special about the location, then they'd like to see that. Otherwise, Midtown New York is just convenient for everyone.
And one place where they don't like it is where we're sitting now. They're not keen on coming down to an exchange for a investor day. How come?
Sure. There's two reasons that they typically say they don't like the New York Stock Exchange. One is just a matter of convenience. For a lot of investors that are in Midtown New York, it's just a lot easier for them to walk down the street than take a train downtown. And another is the heightened security at the New York Stock Exchange. For example, this morning, it took us a good 15 minutes to get in the door. So investors get a little frustrated with that. But, the New York Stock Exchange isn't all bad. A lot of our clients have events here because it's such a great venue. For companies that are listed on the New York Stock Exchange, it's a free venue. They save on costs, which is obviously an important consideration.
Getting into the weeds here, you asked investors threadroom versus theater-style seating. And there's a definite preference there.
Yeah, investors tell us that they prefer classroom seating. They're there to learn. It's an educational day. It just makes things a lot more convenient in terms of being able to take notes, being able to talk to the management team and move around afterwards.
Unless one of the tchotchkes you hand out is a clipboard, maybe they'll be happier with sitting in a comfy theater seat. Let's talk about tchotchkes.
I'd say 96% of the investors we talk to say that giveaways are unnecessary. And actually 20% actually discourage the practice. You want to understand that it's investors' money. So, they're hesitant to give away things that are necessary. And secondly, a lot of people are traveling. So large items just aren't travel friendly. So we would recommend giving away a USB with the Investor Day presentation, as well as other important documents, for example, annual report or most recent, earnings deck, things that are helpful for the investor.
Timing and length.
Sure. So most investors prefer an early morning start. There are some investors that like an afternoon start because they're able to fly in and out the same day. But we recommend starting early in the morning because if you start in the afternoon, you run the risk of, having locals go into the office and then, getting caught up in work and other news events, and that could hurt your attendance because things come up in the office, as you know, and we've seen it happen where you lose a large percentage of the audience just because there's a big news event for the day, or they get requests from clients or they get events from clients or their bosses and they're unable to make the event.
Your research uncovered actual days of the week that are better for investors.
Midweek is generally preferred. For example, Wednesdays and Thursdays are the best days to have investor days. With Friday,
why is that?
It's just in terms of people's vacation, travels, meetings. If you're going to have an event on Monday, out of towners would have to fly in over the weekend. If you're having an event on a Friday, people have to fly out late Friday night. They're not too happy about that. Midweek days are the best for investor days. One of the big draws of an investor day is access to the management team. And sometimes during Q&A session, when investors and analysts are asking questions, the only one answering the question is the CEO. And he or she is dominating the conversation. And so investors walk away with a sense of, wow, what about the rest of the management team? Does the CEO not trust them? Why can't they talk about the business? So that's something for companies to think about. It's really, plan ahead, do mock Q&A session, and get everyone involved. So, we recommend to have the CEO really act as a quarterback during the Q&A session. Maybe he'll make a couple of remarks and then pass it on to the most appropriate leader that can add, real insight and show the strength of the bench. Because that's a big, investment criteria when investors are looking at a company. Do I trust this management team with running this company? And we mentioned this earlier, there are investor conferences throughout the year, and typically, you hear from the CEO and the CFO, but at an investor day, the investment community is really looking forward to hearing from the rest of the management team, business segment presidents and other business leaders that really add valuable insight and give investors a deeper understanding of the company and their strategy going forward.
Thang To, Vice President and Director of IR at Corbin Advisors. Thanks for dropping by the Post.
Thanks, Jeff. It's been great.
And that'll do it for your Ticker Podcast this week. My thanks to Citadel Securities for hosting us at their post on the floor of the New York Stock Exchange. Citadel Securities is a member of FINRA and SIPC. Content of this podcast does not necessarily reflect the views of Citadel Securities. Hope you'll join us again, same place next month. Thank you for listening. I'm Jeff Cossette.